All right, hello everybody, and welcome to our presentation of Bent Creek Condominiums in Rockwall, Texas. And so I'm going to be going through the numbers and giving you a little tour of the property so that if you're interested, you can invest in this. Now, we just did a capital raise about the same size, and it filled up in about 36 hours. So if you are interested in this, I highly recommend that you contact Garrett or Julian as soon as possible to become involved. So right now, this is a picture of the property. We'll do something a little bit more than that, and we'll also go through all the numbers, but let's get straight to the point of what's most important to you. And that's this area right here, okay? What can you expect as an investor? Now, this is a value add play. So year one, we're looking at a very little cash flow, because it is a big value add deal. Year two, we're looking at about $5,000 in returns for a $100,000 investor. Year three, with the cash out refi, getting about 31% of your cash back total between the refi and the cash flow. And then year four, another $6,600. Year five, $7,200. Plus, upon a sale, it's projected at having $129,000 from the sales proceeds. So looking at this, so a $100,000 partner over 5 years can expect almost $180,000 in capital return. Now that's a 1.79 or 1.8 multiplier overall. And if you take that divided by 5, it's a 16% average annual return. So that's important. That's the first part. Everybody wants to know, what do I get out of it? The rest of it is just whether you want to invest in this particular piece of property if you first like the numbers. Now, we can expect a year one 50 to 70% write-off against your taxes because of cost segregation and bonus depreciation. So that's not even included the tax savings for year one. But again, this is not a year one cash flow. This is a value add deal where we're increasing the value of the property. So remember this, first off, if you're interested in those returns, then keep on watching. If you're not interested, then go ahead and pass right now. But let me go through and show you some more, a little tour of the property real quick. First off, where is this property? So this property is located in Rockwall, Texas. That's straight out east of Dallas off of I-30. And so you can see where it's located regarding DFW. It's right by the lake. And zooming in, again, you can drive out I-30 and go across the lake, or Lakeview Parkway, which is 66, going on out to Rockwall. Zoom in more. So here is where the property is located. And this is downtown Rockwall. This is the old town. Actually, Trevino's right here. That restaurant is one of Julian's absolute favorite restaurants in the state. And so that's one of his favorites. This particular area, I'm going to switch over to the satellite view. Okay, again, this is all the downtown Rockwall, you know, the walking areas, the shops, nice. And here is the property here. So just south of downtown Rockwall, right off of this road, this is the property here. All of these units here. Now, if you look behind it and you look around it, there are no apartments nearby. This whole subdivision has 350,000 to 450,000, actually some even over $500,000 homes right here, right behind the subject property. And as far as proximity, it's real close to the lake. You're right here, come right on down here, and here is the lake down on the left-hand side, if you can see it more here. Okay, so the location is great. The submarket, Rockwall, has one of the highest average incomes of anywhere in DFW, over $100,000 per household average annual income. So combined with a high income, high property values next to the lake, there's very little affordable housing in the area. So that makes ours a ripe target. Now I'm going to switch over and show you. Let's go over here. Here is the property. We'll go ahead and do Google Street View so that you can get a better tour of it. Give you an idea. Okay. This is Goliad right here, this road that runs north-south, and this is Lake Meadows on this road here. Over here, this is the only thing I would say would be detrimental. This is actually a housing project. But if you look at it, it doesn't look like housing. There's nobody out milling around. There's not playgrounds. It doesn't look like an apartment community. This is very, not really competition because it is a housing project. Okay, going back down here, the property's on both sides of the street, both the north and south side of the street. Just go in a little bit closer. Okay. 3 stories. It's very dated. You can see the lap siding. Once you start looking closer at it, there's actually a lot of exterior damage. This is a huge value play. You can see this has new supports on these patios. A lot of these patios have to be rebuilt. A lot of old air conditioners. Going across the street. Driveway problems. These are 3-story buildings, and again, it's below grade here, and there is a creek that runs behind the property. From what I understand, nothing is in the floodplain, so that's not a problem, but there has been deterioration, some movement, some building movement. Just keep on driving down the road virtually. This is really handy having this tool. Okay, so those are 2 stories there, and you can see it screened in. Now these were built as condominiums. We're actually buying 97 of the 101 units here. And we're going to do like we normally do. We'd like to buy your unit, and if you don't want to sell it, it's a $15,000 special assessment for us to fix up the property. So we're hoping we buy all of them, but if we don't, it's not a big deal. And we'll probably manage this just like an apartment community, but for those other 4, we'll do extra dues so that we don't have to have a separate HOA involved here. There is an office. I like this guy. He's waving over here. Okay. Let's go down here a little bit farther. Like I said, here's the property, and here's this subdivision right down here. Let's go ahead and just turn around these. Getting a new roof on that property during this picture. But nice looking homes, got a nice boat, and this is right next to the property. Okay, another home. So these are nice homes in this area, and they go right by our very rundown property. Okay, very pretty. Right now the pool is empty. It's been being painted and refurbished. I don't think they're going to do a good job on it, so we put some money in there to redo it. I'll show you something else funny here. See the guy, he's got his hands up, waving. There's a better picture of him somewhere in here. But here, this is the property. Okay, see if we can drive down in here. Nope. Roof's in good shape. There's some drainage issues, landing stairway issues, railing issues. Big CapEx project. We'll go through all that. But this gives you a good feel for the property and why we like it, why we like the location. So let's switch over and go through our actual numbers. Okay. Again, Bank Creek Condominiums, picture of the property, which you just saw. That was the first building as you go on in. Okay. Oops, I made a little error there. Okay. So we're paying $13.5 million. It's $140,000 a unit, which is pretty high for a property that was built in 1972. It's kind of high for 1972, but the location is great. The high income in the area is great. So we like the property. We're budgeting $675,000 for closing costs, $2.2 million for capital improvements, putting $200,000 in our operating account. We've got a miscellaneous number of $25,000. And what that's really designed to do is just in case there's any little extra fees that we didn't account for, but then also to have a nice round number for our capital requirements. So 5.1 is our raise. Sponsorship team is keeping 16%. Guarantors get 4%. Darkwore gets their acquisition fee of 3%. Our loan, $11.5 million is what we're going for. We're using a bridge loan, so I've got a higher interest rate at 3.75. Don't know exactly where that's going to come in, but we'll have at least 3 years of interest only. So we're looking at $431,000 in interest only payments. When we refinance out, $13.3 million at 3.5% with 5 years interest only, and that's at a 65% loan to value. Normally, we look at a 70% cash out refi, but just the way lending's been going, wanted to add a little extra cushion by putting that as a 65% loan to value, I should say. And again, 16% average 5-year investor ROI. That is how much goes to you. So that's what we put in here is not the property level, but what the investors can expect to receive. So 16% per year average return. Unit mix, primarily 2-bedroom units. There's 60 2-bedroom units. We've got 29 1-bedroom, 1-bath. Current rent, I'm not going to go through all the details on this. This is the current effective rent, but it averages $1,022, which is $1.23 a foot. We're projecting on after rehab and updating everything that we'll get these rents here, which is an average of $1,213. So just under $200 rent bumps, okay? Which is realistic. $1.45 in rents, which is completely realistic in that market. In that market, it's as high as $1.65, $1.80, depending on which properties. But obviously, there's nothing real close to the property, so having a direct comp is tough. But given its location, we believe that this is easily attainable as far as rent numbers. Again, we're buying 97 of the 101 units built in 1972. Pitched roof, individual HVAC, individual electric. We do have boilers for hot water. I'm saying a condition, C-. It's in rough shape. The interiors are actually in better shape than the exteriors, which is kind of shocking because we can update the exteriors and still be able to push rent without really doing too much on the interior, but we are still budgeting plenty for the interior. 3-story brick and siding, slab foundation. Here's some of our CapEx budget. Interior update, $700,000. So we're talking about $7,000 per unit on interiors. And that does quite a bit, but it's not going to do everything new. Patios, landings, stairs, $310,000. Drainage, landscape, and grading, $180,000. Retaining walls and foundation, $130,000. We didn't see a lot of foundation problems, but there are retaining walls that are causing additional water flow issues, and so we're looking to have to redo those. Complete exterior paint and wood, exterior lighting. Then we put extra gutters, screens, structural washer dryer rooms. For example, the washer dryers are on the patios, and they've got a very narrow door. So we want to make a larger door so we can have full-size washer dryer connections in there. Maybe we'll even buy washers and dryers and rent them out for an additional profit center. But that is our cushion in there, $510,000 for everything else that we might have in there. Also trying to take into account for the extra cost of materials and labor that's going on right now. Okay. Now, I'm going to jump over here. We know the income's correct. That's how much they've collected between rental income, $1,048,000 and $43,000 in other income for a total income. The expenses are an absolute mess. There are 4 different entities that own units there, and we're buying from all those 4 entities. Plus, there's another 4 owners that own separately, so there's an HOA account as well. So this on the existing numbers, absolute mess. So we didn't even try and break that down. We just went with our own budget that the property management team put together as far as where we think we're going to be on all of our operating expenses. Now, I want to point out something very huge on this. Very, very, very huge. This is a condominium property. Each property is individually deeded. And what that does is that takes you from arguing your property tax value on the commercial side. That puts you into the residential side. Residential appraisals go up, 4 to 6% per year, and that's what we looked at historically on this property. It's been about 4 to 6% average increase per year. On commercial, they'll go back and look at the sales price and say, okay, you've got this sales price, so we're going to raise your values up to what you paid for it, and it's hard to argue that we overpaid for a property. But on the residential side, they look at comp sales. So they're looking at house sales. They're looking at condo sales. They're looking at the comps to this. Now, the houses around it are not comps. These are small 1 and 2 bedroom units, some 3 bedroom units, but they're also condominiums, not homes. So they would look at other comp sales, and they're going to have to spread out farther than the immediate area. So in that, we're looking at a much lower increase in taxes. Let me give you an idea. Right now, I think the property taxes are about $85,000. Of course, we bumped up about 50%, bumping those up over 50% increase. Let's just say we only get that 5% increase or less. Okay, let's change this to $100,000. Okay, so that's $100,000. What do you think that does to returns? Okay, any wild guesses? Goes from 16% to 18.4. Okay. Now we want to be conservative in there to make sure that we're going to accomplish our goals. So we're leaving that 135. And even if not, who knows? There might be a little extra bump in here or more in CapEx that we want to spend. So it's nice to have that cushion. Now this is important. We're projecting $154,000 in cash flow year one. Gives 1.51 debt coverage ratio, cap rate of 4.8% on projected numbers, and cash on cash year one of 3%. 154,000 divided by our capital raise, 3%. However, keep an eye out on this. By the way, again, minimum assumptions. If we screw up, that's what we can expect. If we do really good, that's what we can expect. And I'm still not even as low on my tax number as I could be. So 44,000 on a low side to 373,000 on a high side of cash flow. However, something we've been doing, especially on value add projects, is we added additional cushion down here. I want to point this out. Even though we're showing $154,000 in cash flow year one, I'm putting this additional cushion in there, $150,000 of additional cushion, so that we can expect very little in the way of a return. In these large CapEx projects, there ends up being lower cash flow than anticipated in year one. So we wanted to put that additional cushion in there so that we can outperform. Because if you're happy with a 16% return, if we don't need this, then you're going to be thrilled. But if we do need it, then it doesn't hurt us and you still get those same returns. Budgeting out with 3.5% rent growth, and then expense growth at 2%. Collection loss year one at 16%. So what that is we budgeted at 22% vacancy and collection loss. So that's 6% on vacancy because they're 98, 99% occupied and they stay that way. But 6% on vacancy and 16% on collection loss. And that's because we raised rents. So we can't turn all the units immediately and have a low collection loss. It's going to take us a year to do that. We're also looking at the possibility that we're probably going to have to change over all of the residents in that property. Now, again, we anticipate changing all the residents over, but just like we've seen at other properties such as Amber Vista, we went into Amber Vista, rents were $900. We were updating the units and getting $1,200. But the residents that were there saying, hey, we want to stay and we'll go ahead and pay the $1,200 a month, to go and do that. So all the same residents stayed there. They just moved into newer, nicer units. So, that's always a possibility here, but we're budgeting for having the turnover anyway. So 16% collection loss to get those all up. So in the future, we're budgeting 8% vacancy and collection loss, which is pretty optimal. And given this great location, I think we're good to go. Again, the additional cushion that's in there, total expenses are still going up, net operating income is going up. And we're looking at a value in year 3 of 4.5 cap. Okay, so 4.5 cap in year 3, 4.4 in year 2, 4.2 in year 1. So we're looking at going in at a 4.1% cap rate right now, which I think would be market for this particular property, especially being a value add property. So we take the NOI divided by the 4.5 cap to come up with value. We're looking at a 65% cash out refi, so $13 million valuation. Pay off the existing loan, which didn't go down because it's interest only. We'll have costs to pay it off of $200,000. So we'll have proceeds of $1.6 million. That $1.6 million goes from there up to the property level pro forma. On distributions, there's that $1.61 million. Now, just for grins, what happens if this is a 70% refi? Okay. This is what's funny is, yes, you get a higher cash out refi, but the overall return drops down a little bit because of the extra costs involved with that. Okay. So 65, not only that, 65% will give us better interest rate, better terms. The lower you can go on that, you go down to 60%, it does even better as far as our rate and term, and our return goes up a little bit. Okay. Now we're looking at year 5, same thing. Now year 3, 4.5, year 4, 4.6 cap rate, year 5, 4.7 cap rate. So we're bumping up those cap rates every year to 4.7. Sell it for that number. Cost us 2% to sell it, pay off the existing loan, which is, again, interest only, so the loan dollars don't change. But our proceeds of 7.606. Again, that translates right over here to the proceeds. Then you times that by what a $100,000 partner has. So a $100,000 partner would own 1.57% of the property. So you times that by 1.57, and that's the cash flow that a partner can expect to receive. So again, year 1, don't count on anything. Value add deal. That's how it always is on value add deals. Year 2 will have cash flow. Year 3, a refinance. Year 3, a refinance, which allows us to go ahead and distribute money, tax-free cash back to the partners to reinvest or do whatever you want to with, and then holding on to it for another 2 years projected. Again, could go longer, could go shorter, depending on what's going on in the market. Okay. A couple of additional notes. We did not budget to buy the remaining 4 units, but we also did not include that income in our calculations. The lender will provide extra $400,000 to go ahead and buy those extra units, or we'll do partner loans depending on how that whole thing works out. But we have it in the PPM to allow us to do either. And again, the big benefit as individual condos, they're not taxed as heavily. The values do not get adjusted as much. So this is the property, and we have got a great deal here. We think we're going to raise the money in about 36 hours. So like I said, jump all over this if you're interested. The location is great. The returns look very good. And, with having additional cushion in there, shows that we're being a little more conservative, even though everybody says they're conservative. And so those are the numbers. So if you want those type of returns in a nice solid asset in a great area, then definitely reach out to Julian and Garrett as soon as possible. And we'd love to have you as a partner and look forward to meeting you and seeing you out on the property or at one of our events. And thank you so much. Get involved. Bye.